Hi guys, so welcome to the options trading strategy video series. I've divided this video series into 5 parts. In the first part, that is this one, we'll be studying about some basics framework that we need to know before we venture into options trading. In the second part, I'm going to get into call option strategies. Part 3 will be about put option strategies. I have dedicated a complete part 4 that is on open interest and options because this is one topic that intrigues a lot of traders. And finally, the part 5th will be about charts and examples. Now, part 2 and 3, that is call options trading strategies and put options trading strategies, will be divided into many sub parts because there are many strategies associated with both call option and put option. So this is how we are going to progress, and this is our first part where I'll be just covering some basics. So let's get started.
In this channel, we talk about trading, investing, and market analysis to help you become a better investor and trader. So if you are new here, consider subscribing.
So this first part of this options trading strategy video series will be that is of basics. Now in this part, I'm going to cover basics of options and how they are different from stocks and futures. I'll also show you what are the type of options, that is call options and put options, along with what expiry in option means, strike price. I'll be talking in brief about options Greeks as well, but this is one topic I'll be covering in great detail in subsequent parts. In this particular part, I'll be focusing more on theta, delta, and gamma, and I'll be leaving vega and rho for the later parts. Then I'll be summing up the use of options and why options as an instrument should exist in your trading arsenal. Just a reminder, this part is more theoretical in nature because we need to have some sort of framework first before we can go and learn more about strategies and how to structure trades in options. So I'll come to what are options first. Now see, in our market, or rather most of the markets all over the world, you'll find two main asset classes in stock markets. One is equities and another is derivatives. Now within the derivative segment, we have futures and options. So options are actually derivatives instruments that are available across most world markets. You can have options on stocks, on index, on commodities, and on currencies. For this particular series, I'll be focusing only on stocks and index futures, index options. But whatever principles I'm going to show you does apply to currencies and commodities as well. So since options are belong to the derivative class, they kind of derive their value through the underlying stock, index, commodity, or currency, which is why they are derivatives. That is, they are deriving their value out of something else. In this case, it can be a stock or an index. Options, why is it called option? Because it actually gives you the right to buy or sell at an agreed price. You don't have an obligation to do so, which is why the word option was coined. So the agreed price and agreed time, that is something I'll be coming in the next slide. So let us start with strike price first. What does strike price mean in options? So all options contract that you see, let's say in our markets, Nifty is the most popular instrument. And if Nifty hypothetically is trading at 11,570, like I've mentioned in the slide here, so you'll have call options ranging from 11,400, 450, 500, 550, 600, so on and so forth. Similarly, for put options, you will have 11,400 put, 450 put, 11,500 put, 550 put. So all these prices that you see here, these are strike prices. So the definition of a strike price is that each option contract is actually associated with some strike price. In this case, while Nifty is at 11,570, the strike prices are following. It can also be 11,300, 200, 100, and so on and so forth, depending on where the liquidity lies. So this price actually remains constant because this is where the settlement takes place, either if you want to exercise the option or when the option naturally expires due to its expiry cycle. So lot size. Now what is lot size? Lot size is actually determined by the exchange and the regulatory body, but is actually a fixed number of units of the underlying asset or the stock that the option holds. Again, we'll take the example of Nifty. Nifty has a lot size defined of 50. And for Bank Nifty, I think it is 40. So this lot size depends on the margin requirement and is actually it's actually set by the regulatory body. Now, what do we mean by premium? Now, premium is what option buyer pays in order to buy the option, right? So I'll just put up one difference here. There are two main segments in options. One is an option buyer and one is an option writer, that is option seller. So when you're an option buyer, premium is the price that you're paying to own that option, right? And when you're an option writer, that is you sell the option first, the premium is the amount that you will receive once you start writing or selling options. I hope I'm clear in this. So now we come to expiry. So expiry is it's basically the date on which the option expires. Either it will expire in the money, out of the money, that depends on the option. But in our markets, it's usually last Thursday of a month. In case Thursday is a holiday, expiry would happen on Wednesday. In case Wednesday is also a holiday, it would expire then on Tuesday. That is the last trading day in case Thursday is a holiday, right? And open interest, of course, it's a very popular topic. Open interest is nothing but the number of outstanding options contract in the market. Now, these are the contracts which have not been closed, which have not been exercised, and which have not expired based on the expiry cycle. So today we are in August. So I think this month expiry would be last Thursday, which is coming up. One thing I want to put up in expiry section is that now in our markets and many markets over the world, you have weekly options as well. That is options expire every week. In our particular market, there is only one instrument, that is Bank Nifty, in which weekly options are available, and they kind of expire every Thursday, that is every week. So this is how a basic option chain looks. So this is call option and this is put option. This is for Nifty. Now look at the strike prices here, which I showed you in this previous slide. So 11,500, 550, 600, 650, so on and so forth. These are the strike prices. The LTP that you see, that is the last traded price, the 241, 193, 147, and so on and so forth. This is the premium that you pay here. So lot size column is not there, but in case you want to go and buy or sell this option, the minimum lot that you have to select, that is one lot of option for Nifty, that would be about 50. And here is the open interest data. And this bid and ask data is something, it's not required at this stage. Only when we'll be discussing strategy section, I'll be focusing on this. And there's one more column you see here, that is IV. Now this is implied volatility. Again, I'll be covering up this when I talk about Vega. I'll just take you back 2 slides. Remember the options Greek segment, that is Theta, Vega, Delta, Gamma, and Rho. So I'll be discussing about implied volatility, that is the column we saw here, when I'll be coming to Rho and Vega, right? So this is how an option chain looks like. Now there are many sites that actually provide you option chain. The most standard is BSE or NSE website, but there are some brokers as well who give out options chains data for free. I'll post those links in the description box below. So now let me come to what option premium means. Now this slide that you see, this last traded price, and both this for put options, the LTP is here. For call option, the LTP is here. So this is premium, right? So what is this premium actually made of? That is what I want to explain. So options premium actually has 2 main components. One is the intrinsic value, that is the built-in value of the option. And another one is the time value of option. Now premium I have written here is intrinsic value plus time value. Now how do you determine the intrinsic value? The intrinsic value of call option is derived by underlying price minus strike price. I'll just explain it here. So let us take this option chain as an example. Now the Nifty spot is trading at 11,570, and which is when I have taken this snapshot. So let us take 11,400 call for this explanation. Now, if you see the 11,400 call is trading at a premium of 200, right? 200. So how do we determine the intrinsic value? Remember, in the call option section, I have mentioned that the intrinsic value is determined by underlying price minus strike price. So what is the underlying price here? It is the spot price, that is 11,570. And what is the strike price? It is 11,400. So for the intrinsic value, we subtract 11,570 minus 11,400. So the intrinsic value is 170, right? So how do we determine now we come to time value. Okay, so how do we determine the time value? Time value is calculated as option premium subtracted by intrinsic value, which we derived in the earlier step. So in this particular case, the premium was 200, right? And what is the intrinsic value that we determined? 170. So what is the time value? Time value is 200, that is premium, minus intrinsic value, that is 30. So in case you're buying this call option, 11,400 call option, what you're essentially doing is that you're paying 170 out of this 200 as intrinsic value and 30 is for time value. Now what do I mean by time value? I'll just come to it. So by now you would have come to know that intrinsic value is only present in the money options, because let's say spot is trading at 11,570 and you want to take out 11,600 value. So what is the formula? The formula is spot minus the strike price. So this will be negative. So which is why out of the money call option, they usually don't have any intrinsic value. They only have time value. Now I'll come to in the money, out of the money, and at the money call option in a bit. So when you're trying to buy an option, always be sure that what you're paying for intrinsic value and what you're paying for time value. What does time value mean? Well, let's say we are planning to buy a call option which is expiring somewhere in September. Now, naturally, September expiry is pretty far away. It's almost 40 days. So obviously that particular option will have a lot of time value, right? Because it has a lot of days to expire. Now this concept I'll be covering in Theta, so don't get too confused here, but just keep in mind that only intrinsic value is only present in the money option. As out of the money option you go, intrinsic value does not exist for those options, only time value exists. So which is why, see, out of the money call option means something in the future. So future will only have time value. There won't be any intrinsic value in that option. In case you were slightly confused, just pause the video here, go back and study this section again. But what I would suggest is just carry on. This is a new concept. Options trading is sort of confusing for most people who are new to trading. So just complete this video series and I'm sure most of the doubts would be addressed. So before moving to in the money, out of the money call option, I'll just come to how options are actually different from stocks and futures. So if you've been trading in the market for long, you would know that stocks typically don't expire as such. Stocks exist till the company exists in the market, right? Options usually have a fixed expiry date associated with it, along with futures like Nifty futures, Bank Nifty futures, they expire every month, which is why positions are rolled over. And same applies to options. Options expire every month. Expiration date can be either in weeks, months, that depends on the kind of option you're trading. That is, if you're trading in Nifty, the Nifty options expire only last Thursday of month. And if you're trading in Bank Nifty has two variants. One is the weekly option and one is the monthly option. Another difference is that stocks usually carry dividends, whereas options, you don't have any dividends as such. You'll also find that most of the stocks in the market, if you just ignore micro cap or extremely small cap stocks, most of the stocks are fairly liquid. That is not true for options. Options usually are liquid for, let's say, 2-3 strike prices. After that, the liquidity does tend to go down. And there are something called as leaps. That is only long-term options. They are not yet that active in our market. But which is why you can only, if you want to hold something for a very long time, you can do it in form of stocks. But for options, since we don't have long-term options yet in our market, or rather we have it, but they are not that liquid. So which is why options differ from stocks in our market in one main criteria, that they kind of expire every month. So now let me come to the type of options that are available. So one is the call option and one is the put option. Now, what does call and put option mean? So both call and put option are actually available for stocks, index, currency, and commodities again. And this is standard all across the world. In our markets in particular, you will find that index and stock options are by far the most popular, right? Currency options, commodities options has just started in our market. But apart from, I think it's in gold, I think, if I'm not wrong, but there's not much the kind of liquidity that index and stock options have. I don't think gold options have reached that liquidity yet. So what does call option mean? Call option gives you the right to buy, right? And remember one thing, the main difference, the main definition of option is that it gives you the right but not the obligation, right? So call option gives you the right to buy. So what typically people do is that it's actually an extremely low risk way to participate in buying an index or a stock. Now this risk segment calculation, I'll come in the last slide. Similarly, if you look at put options actually give you the right simply to sell. Again, no obligation is attached. It's kind of a low risk strategy that people use to profit from fall in stock or fall in index. Whereas in call options are typically used as a low risk strategy to profit from rise in index or rise in a stock. Now the safest way that I categorize that you can participate in options is simply to buy them. So that is actually the most safe strategy that you can have in options. There are some advanced strategies in buying options also, which we'll come into later in the next subsequent parts. One thing that has caught up in recent time is selling or writing options. Now retail segment especially is kind of more gravitated towards selling or writing options. I will be showing how to do this, but just at the outset, let me tell you one thing, that in case you don't understand the risk of writing or selling options first, please be careful, because this is becoming a hugely popular strategy and many of the retail traders are trying to do this. I just hope that everyone who writes the option actually knows the risk that is associated in writing options. The safest way, again, in my opinion, is to simply buy options, and I'll be showing you how to do it in a very, very safe way in the subsequent parts. So let me now come to options expiry. Now, I had just given you a brief overview that options expire on a monthly and weekly basis. Now, I'll just take you in some detail here. Now, depending on where you trade, options actually expire either on a weekly or monthly basis that we've seen. In our markets, both weekly and monthly expiration is available. Most of the instruments that we trade are for monthly expiration, leaving only Bank Nifty. And Bank Nifty also, it's available in weekly and monthly option. Weekly expires every Thursday, that is every week. And the monthly options in our market expire every Thursday, that is last Thursday of the month. Now this information is relevant to our stock market only. I'll come to strike price. Now, what do I mean by in the money, at the money, and out of money strike price and options? Now, remember, I've just explained you a brief overview I've given of strike price and options. Now, I just want to explain what does ITM, ATM, and OTM mean. Now, ITM means in the money option, ATM means at the money option, and OTM mean out of the money option. So I'll start with in the money option first. So let us assume that Nifty spot is trading at 11,000, right? So all strike prices that are below 11,000, that is the spot price, that will automatically be in the money call option. Why? Because already the option is in the money, it has some intrinsic value associated with it. So the example would be 10,900 call option, 800 call option, 700 call option, 500, 600, 400, 300, so on and so forth. All these options that are below this strike price level, below the spot level, these will be in the money call options, right? I hope this point is clear. Similarly, let's come to in the money put option. So again, assuming that Nifty is trading at 11,000, all the strike prices that are above 11,000 would be in the money put option. Why again? Because obviously intrinsic value is associated with in the money options. So for example, 11,100 PE, 200p, 300p, 400p, so on and so forth. All these are in the money put options. Now, what are at the money option? At the money option is fairly straightforward. Let's say Nifty is trading at 11,000. So 11,100 spot. So 11,100 call option and 11,100 put option would be actually at the money call and at the money put option. So this is extremely straightforward. So let us come to out of the money options. Now, out of the money option is where maximum percentage gain lies in case you are trying to participate in option. Why? Because this is associated with future movement. Remember, when you're talking about in the money option and Nifty is at 11,000, the premiums in these in the money will automatically be high because the option premium will have two main components, that is intrinsic value and time value. But when you come to out of the money option, the premium is only made of time value, no intrinsic value. Why? Because this is into the future. So suppose Nifty spot is trading at 11,000. All the strike prices that are above 11,000 will be categorized as out of the money call option. Now this means 11,100C, 200C, 300, so on and so forth will be out of the money call options. Now similarly, when you come to out of the money put option, suppose Nifty is trading at 11,000, all the strike prices that are below 11,000 will be categorized as out of the money put option. Why? Because spot is 11,000 and this is in the future that you are expecting that price will move to either 10,900p, 800, 700 or 600, right? So these are out of the money put option. Now I'll just explain it through a basic chart. Let us assume that Nifty is at 11,500 spot price. Now all these options that you see, 11,450, 400, 350, 300, all these are in the money call option. Okay. Similarly, if you see 11,500 is the spot level of Nifty, all the option strike prices that you see at 11,550, 11,600, 11,650, 11,700, so on and so forth, these are in the money put option, right? So these premium value that you see, that has intrinsic value plus time value. Similarly in put, the intrinsic value that you see here for in the money options, these have intrinsic value plus time value. Now let us take a look at out of the money option. Now in this out of the money, again assuming that Nifty is trading at 11,500, all the strike prices that are above the 11,500 spot price are out of the money call options. So 11,550, 600, 650, 700, so on and so forth, these are out of the money call options. In puts, all the strike prices that are below this 11,500 spot level are out of the money put options. That is 11,450, 11,400, 11,350, 11,300. These are all out of the money put options. Now these premium value that you see in this case and in this case, these only have time value, no intrinsic value. Why? Because it is out of the money, that is into the future. So now we come to options Greek. Now options Greek is one topic which especially new traders don't kind of want to pay attention to this. It looks complicated and maybe for that reason they don't go into the depth of options Greeks and they simply want to trade out of option charts only. Now trading out of options charts is also a good method. I'm not saying it's not, but I think if you have some basic idea of options Greeks, then I in my personal opinion, that will actually really help you in structure your option trades better. Now the first option Greek concept that I want to focus on is theta. And in this particular segment, I'll be only taking up theta, delta and gamma. And as I had mentioned earlier, the rho and vega, I'll be taking up only when the relevant strategy comes into play. So what exactly does theta mean? So theta basically measures the rate of decline in option premium due to passage of time. Now what this definition means is that, now look, suppose we are in the first week of August with the expiry date for Nifty option, that is monthly option, due on 30th of August, about 25 days later. So remember I told you that all options that is in the money options have intrinsic plus time value, and all out of the money options have only time value. Now that time value is essentially the number of days that are due for that options to expire. So what I mean by that, now again, let's say we are on August 5th and Nifty 11,000 option, we are getting 11,000 is the spot price of Nifty, and 11,200 call option, that is out of the money option, we are getting for 50 rupees. Now the 50 value that you see, that 50 value is only time value, right? So that time value is because there is 25 days still left for the option to expire. So as option nears expiry, the time value of the option goes down. Why? Because the number of days to expire becomes less. So that is where theta comes into play. So theta measures the rate of decline of option premium as your expiry date nears. I hope this is clear. So quite often this is popularly referred as time decay in an option, right? So as the expiration date will get closer, you will see that most of the options start to lose their premium because it's going to expire, which is why the time value of that option starts going down. Now, how time value and theta actually impacts the option participant depends on what kind of option participant you are. If you're an option buyer, then obviously theta impacts you in a negative way because as time progresses, option keeps losing its value. In case you're an option seller, then theta actually works in your favor because as you have, once you sold the option, the premium comes to you and it is in your interest that the option actually expires worthless. That is, with time, the value of the option nears zero, right? So again, this is what I've mentioned here, that if you're a writer, theta actually works in favor of you. If you're an option buyer, then theta is one thing that you always have to keep in your mind. Now I'll just demonstrate a practical example of how theta works. Now this is the option Greek chart. So if you look here, Nifty spot is trading at 11,570 and this is the Greek spot. So here we have rho, vega, gamma, theta, delta. So let's come to 11,600 call option, that is out of the money option. So the premium that you see here 52, this only has time value, right? Because it's out of the money option. So do you see this theta column? The value is -7. Now I'll just tell you what this -7 means, because -7 and you take this 52 premium value and see the days of expiration, that is 6. So what this -7 means is that as of today, with 6 days to expiration, every day this option is set to lose 7.2 of premium value. That is with 6 days left to expire and theta -7, the premium is 52, right? So next day, that is 5 days left to expiry, subtract this -7 from this premium value here, you will get about 47, right? No, you'll get about 45, I think. Yeah, 45. So with 5 days left to expiry, the premium value should be 45. Once you have just 4 days left to expiry, again subtract this -7. Mind you, what will happen is that with 6 days left to expiry, the theta value is -7. With 5 days, this theta value would go up to -8 or -9. So I hope now you know how to use theta value in practical example. When you see theta value as this and you see premium value here, calculate the number of days to expiry and see how each day this option premium is set to reduce by this margin till expiry. I hope this is clear. So this is how theta actually impacts the price of option. Now this is a 90-day expiry chart, that is 90 day to expiry. So initially the impact of theta, that is time decay, is pretty less there, but as expiry nears, see how this option vertically falls down. Now this is what happens as expiry nears. You will find that theta comes into play and option kind of loses its premium very fast. It is kind of flat in the starting, but then it just falls off the cliff. That is how theta impacts the pricing of option. And this particular point you see here, this is where maximum option writing happens, because there are just 10 days left to expiry, 15 days left to expiry. Traders think that, this option is out of the money, it has some decent premium in it, let's go and write it. But quite often, if you have been in the market, you would be seeing that on expiry day, sometimes options go from a 1 rupee premium to, let's say, 400, 500 rupee premium. So that is the sort of risk that exists while riding options. But I'll be showing you how to kind of measure that risk and how to practically construct a trade so that you don't get trapped into that particular scenario. So I'll just repeat this once more. Take the theta value and subtract it from the premium to determine each day the premium loss in that particular option. So you just need 3 components here. The first component is strike price in order to check out of the money call option. Second is the number of days to expiry. In this case, it is 6. And third is the theta value. Again, this options chain, that is Greeks, will be available with your broker as well. Just check it with him. I don't think Greeks is available on NSE website, but I'll just check. And I'll put up some links in the description box below so that you can directly go and check the Greeks value for your option. And you can apply this concept from tomorrow itself. So now let me come to options delta. Now, remember there are 3 main option Greeks that we are discussing in this part. That is delta and theta and gamma. So what did theta measure? Theta measured the rate of decline of option with respect to time, right? That is days left to expiry. Now what does delta measure? Delta actually measures the rate of change of price of the option with rate of change of price of the underlying asset. That is, a Nifty call option delta would measure the rate of change of Nifty call option with respect to the rate of change of underlying asset, that is Nifty itself. So it's popularly defined as, the sensitivity segment of an option with respect to its underlying asset. For call options, you will find that delta ranges from 0 to 1. And for put options, delta ranges from -1 to 0. Or why is it inverse? Well, because that is what call option and put option is. When asset goes up, call option goes up. When the asset goes down, put option goes up, right? So I'll just tell you what gamma basically means. So delta is measuring the rate of change of price of an option with respect to the underlying price of an asset, right? So what gamma measures is the rate of change of delta itself with respect to rate of change of price of underlying asset. So again, I'll repeat. Delta measures the rate of change of price of an asset with respect to rate of change of price of an underlying asset. And gamma measures the rate of change of delta with respect to rate of change of price of an asset. I hope it's clear. Now the practical application of gamma, I'll be showing you only in subsequent parts. But again, I'll just explain you how to make use of delta right from today. I'll take up a practical example again. So again, let's assume that Nifty is trading at 11,570, that is spot. So all call options that are above this 11,550 range will be OTM call options, right? That is out of the money because they have only time value. Similarly, call options that are below this 11,550 range, they will be in the money call option. Now I'll just take you to this slide. Again, this is the Greek segment. I've highlighted the delta part here. Now look, 11,570 is the spot price. Days to expiration is against 6. So let us take up 11,400 call. Right? So 11,400 call has a premium of 191. Right? And let us measure the delta value of 11,400. It is 0.8. Okay. Now let's come back here. So 11,400 has a delta of 0.886. That is we saw here. Right? So what does this value mean now? Now what this means is that with everything else constant, 100-point movement in Nifty, that is the underlying asset. Remember, delta measures the rate of change of price of option with rate of change of price of underlying asset. That is Nifty in this case. So with 100-point movement of Nifty, 11,400 call would move by 88 points. Why 88 points? Because you take the delta value of 0.886 and you multiply it by 100-point Nifty movement, because that is what we are trying to measure. So that comes out to about 88 points. Now at this, what is the premium that we saw? The premium is 193. So when Nifty will move 100 points from this level, this option, that is 11,400 call, will move by 88 points. So the premium that you can estimate when Nifty moves 100 point would be 193 plus 88. So I hope I'm clear. So this is how you have to move, you have to measure the potential movement of your option price with respect to the underlying asset. Now that is what delta is all about. Now ask yourself this: today, if you have an open position in a call option, if I tell you that tomorrow your asset is going to move by 10%, how much will your option move? Do you know that answer? In case you don't, delta is the answer for you, because with delta you can potentially estimate how much your option premium is going to move when your underlying asset moves, right? So again, with delta, you just estimate how much your option will move if your underlying asset moves by X point or X percentage point. That is the use of delta. Again, how it is used to shape up an option strategy, that we'll be only covering up in the later parts. So I hope by now theta is clear to you, delta is clear to you, what are the kind of options that is clear to you. In the money, out of the money, at the money option is clear. You're also clear about strike prices, expiration, and time value, intrinsic value, all these concepts. In case you have any doubt, just roll back this series again and start watching the video, because if you're already new to this market or you've been in this market for a long time, then obviously these concepts would be familiar. But in case you are new to options trading, then make sure that all these concepts are clear before you start moving ahead. Now let me come to what is the use of option. I mean, why do you want to learn about options? So the first thing is that is options for regular income. Now this is one segment that has gained so much of traction over the last 1 or 2 years that you can see a lot of people trying to put up strategies through which people can regularly derive income from option selling. In our particular market, this has got more popular since Bank Nifty weekly options were introduced. In my personal opinion, while regular income strategy is definitely something you can look at, it has some merits, but you have to understand the risk that is associated with writing options. And before you try to estimate what kind of gains you can get out of option writing, please make an estimate of how much you can lose with this as well. Again, the most common strategy that remains is that people try to write options close to expiry, or let's say weekly expiry. I've been in market for a long time. I don't want to say XYZ strategy is wrong, but please understand the risks that are associated with writing options, because your gains in writing options are always capped. It's always limited to the premium you will receive while you write options, but losses can be unlimited. Your entire account can be wiped off in one single trade. And quite often I've seen people writing options without understanding the underlying risks. So it is one of my motive here that through this series I'm going to show you how you can write options as well as buy options with extremely limited risk, and it will actually help you make consistent returns. But in case you are writing options as you're watching this video and you don't know your potential losses, please stop and try and only focus on getting proper knowledge while writing options, and only then proceed. The second main use of options is hedging, that is protecting profits. Now, hedging is actually very similar to insurance. Like we all sort of buy car insurance, health insurance, housing insurance, even business insurance. Why do we do that? We do that because we want to protect ourselves from any untoward incidents or event that may come up, right? So that is what options does for you in stock markets. It's very similar to insurance. You pay a premium again in insurance for car, or house or health, you pay a regular amount of premium. The same is for options. So if you want to hedge your portfolio, let's say you have a portfolio of 50 lakhs, right? And you have something like a general election that is coming up next year. So how do you insure your portfolio in case the market fluctuates 10 to 15% during that phase? Now that is where options are extremely useful, and that is where theta, delta, and gamma become very useful, along with rho and vega. So with delta, you can easily estimate how much the option would move and how much positions you need to build. Through rho and vega, that is volatility factors, the strike price selection comes into the picture. So all those things, how to put this puzzle together, that is what I am aiming to complete in this particular options trading series. Hedging strategies in specific, again, I'll be coming up in the later parts. So one more use of option is that of return on investment and leverage. Now see, with options, you can easily take up leverage. What I mean is, suppose Nifty is trading at 11,400, right? And you're estimating that Nifty can go to 11,800 this month. What you can do is you simply buy 11,700 or 600 call with a very less premium. It would only have time value. It would be about 50 bucks. And you just need to go and pay that premium, and you can own Nifty 50 as such. But if you kind of want to, let's say, hold 1,000 contracts of Nifty in futures, the amount of margin that you would have to put up would be really huge. Plus, you would have to deal with mark-to-mark losses on a daily basis, and you would be exposed to a risk of untoward event happening. Let's say tomorrow market gaps down 10%, whatever the notional value of your trade is, you lose 10% on that. But in options, that's not the case. In case you are buying a far out of the money option, you just stand to lose the premium that you've paid. That is only when you're buying, right? So naturally, with a very less premium when compared with the future, you can easily own same amount of asset that you want to hold in future or in stock, but with extremely low risk. That is what the beauty of options is. Another advantage is that is return on investment. Now, if you're putting up a 50,000 or 60,000 trade, and if you make 2 or 3 times of it, let's say it gives you about 1 lakh or 2 lakh profit, then your return on investment is somewhere between 200 to 400%. Now that is again only possible in options because it takes many years to do that in stocks, and same with futures. So the main advantage when you're buying option is that you can easily imitate a position in index or stocks, but at a very low cost. That is the only premium that you pay to acquire that option, right? I hope my point is clear. So again, whether it comes to ROI, leverage, or it comes to hedging, or it comes to regular income, all these aspects we'll be covering up in the various call option and put option strategies that we discuss. So I'll just sum up the key points for this first part. So what I'm going to do, how we are going to proceed forward from here on, is that the next subsequent parts will be on call option and put option strategies. Please remember, this call option part and put option part will be divided into many sub parts because that is the nature of so many strategies that exist in the market. Then I'll be moving to open interest and its applications in options trading and how it helps you to construct your trade better. I'll be also taking up a completely different topic on how you can trade options through option charts. So there is just one thing I want to tell you. Along with options, I'll be starting up with one more topic. So which is why this options trading topic will continue for a substantial amount of time, just because the subject is so vast. So thanks a lot for watching this video. In case you have any doubt regarding what I showed you, just leave a comment below and I'll get back to you as soon as possible. Thanks a lot, guys.
Click on the subscribe button and bell icon to get instantly notified when a new video is uploaded. Thank you for subscribing.